Hi student, how are you? I hope you all are fine. I'm your tutor of SBR and FR. My name is Abu Bakar Siddique, and today I'm going to discuss a question relating to SBR, Strategic Business Reporting, from March-June 25. The name of the question is EGAP company, and this is question number one of the paper. And as you all know, that the first question of SBR is always from the group account. So this is the question which we are going to discuss. As you can see your screen, SBR March-June 25 EGAP company. So before we discuss the question, let's have a look of the paper. And so this is SBR March 25 EGAP company. So first of all, let's read the three requirements of the question. Then one by one, we will go with the requirement. So the first requirement is, as you know that we have exhibit. So in question, we have three exhibits, exhibit 1, exhibit 2, and exhibit 3. So first requirement is, using exhibit 1, explain with calculation and in accordance with IFRS accounting standard how to correct the accounting treatment of investment in B company, Bryn company, in the consolidated financial statement for the year ended 31st December X7. Your answer should include the revised calculation of the goodwill arising on the acquisition of the Bryn company. So in this exhibit, there might be some information about the acquisition of a subsidiary company with the name of Bryn company, B company, and there might be some problems. We have to discuss those problems. We have to discuss the right treatment, and then we have to calculate the revised goodwill on the date of acquisition. And the second requirement, the B requirement, is that using exhibit 2, explain with calculation and in accordance with IS 19 employee benefit how to account for the defined benefit plan in a consolidated financial statement for the year ended 31st December X7. So there are some issues with employee benefits, which is a defined benefit scheme. That is an issue of IS 19. Post-employment benefits. So we might have some issues relating to the post-employment benefit that need to be explained, that need to be discussed, and need to rectify certain things. So for that purpose, we will be having the second requirement. And the first requirement having 10 marks, the second having 8. So there are total 18 marks. And then the third requirement is that using the exhibit 1 and 2, means the thing which you have concluded in part A and part B, so requirement A and requirement B. So using the exhibit 1 and exhibit 2 and your previous answer, adjust the pre-populated spreadsheet response option to correct the draft consolidated financial position as at 31st December X7. So in the question, there is a pre-populated financial position which you can see at your screen. This pre-populated financial position we need to adjust with the information given in exhibit 1 and in exhibit 2. Exhibit 1 and exhibit 2. Using that information, we have to adjust the balance sheet, financial position, as you can see at your screen. So this is a pre-populated spreadsheet. So we have 3 exhibits which we have to, in first 2 exhibit, we have to discuss, we have to explain. And in a third exhibit, we have to, in a third requirement, we have to adjust the financial position with the exhibit 1 and exhibit 2. So now, without any further delay, we will study one by one. First of all, we will study exhibit 1, and then we will debrief the answer, and we will incorporate that answer directly in a spreadsheet, which is the part C of the question. So, the first exhibit that is relating to the acquisition of the B company. So, on 1st January X7, EGAP paid 4.3 million to acquire 25% of a $5 million one equity share of the B company. So they have acquired 25% of the 5 million share of the B company on 1st January X7. And the consideration which they have paid is worth of 4.3 million US dollar. This shareholding enabled the EGAP to exercise significant influence over the B financial and its operating policies decisions. EGAP recorded this investment. In B at cost within financial asset in the draft consolidated financial position, and no further entries have been recognized. Now, let me quickly give you a debrief on this. Now, here they have did a wrong accounting treatment. They have a significant influence over the B company. But what they have done, they have treated it as a financial asset in the consolidated financial statement, which is totally wrong. Because if you have a significant influence over the investee company, then in a consolidated financial statement, it is mandatory that you must apply equity method. According to IAS 28, which tell us what is the equity method which is applicable on investment in associate and joint venture. So treating it in a consolidated financial statement as simply a financial asset is totally wrong. It should be treated as an equity investment, first of all. Then continue with the question reading. On 31st December X7, at the year end, EGAP acquired further 45% of the B equity share and gained the control. Consideration comprised cash of 15.1 million, and 1 million of EGAP 1 equity share, which had a fair value of 3.2 million. So one type of consideration they have paid for 45% is 15.1 million cash, and the second type of a consideration is the share exchange. They are giving their share to acquire the subsidiary company to get the 45%. They have issued 1 million shares of a EGAP, and at the date when they acquired further 45%, on that date the fair value of the each share was 3.2. At 31st December X7, The B company quoted share price was 5.7. The fair value of the B identifiable asset on December X7 was 40 million, which was the same as the carrying amount in the individual financial statement. In the year ended 31st December X7, B reported a profit of 2 million and no other comprehensive income. In the draft consolidated statement for the year ended 31st December X7, B treated as a subsidiary and accounted for using the acquisition method. In the draft consolidated SOFP, NCI was measured at the date of acquisition at the proportionate share of the fair value of the B identifiable net asset. However, the policy of the EGAP is to measure the NCI at fair value. So they have treated it as a subsidiary, and it has to be treated as a subsidiary because if you have 25% previous holding and you have acquired further 45%, it gives you total 70%. 70% holding over the B company. So you have a control by any definition. You have a control over the B company. So it is now your subsidiary and it should be accounted for using the acquisition method. But the first mistake which they have done here, according to the question, is that they measure the NCI at a proportionate value. Despite that, the policy of the company is to use the full goodwill method, is to measure the NCI at fair value at the date of acquisition. And the goodwill which they have calculated is as follows. They take the 45% shareholding at cost, 15.1 million. Another mistake, they considered only the cash consideration. They ignore the share exchange. 1 million share they have issued. That should also record it at fair value of the consideration at the date of acquisition, which is $3.2 per share. So 1 million share into 3.2 million US dollar share exchange consideration, share consideration in a business combination. They have ignored that. They have ignored that, the share consideration. And another mistake which they have done here, it is a step acquisition. It is a step acquisition, and in a step acquisition, previous investment should be taken at fair value. They haven't done it. You can see at your screen in the question. And then they have take the NC at a proportionate basis. As we discussed, their policy is the full goodwill method, but they are taking at proportionate basis. That is another mistake. That is 4.2. Fair value of the net asset is 14, and they have calculated the goodwill at 5.3 million. And no accounting entry have been recognized in respect of the issue of EGAP equity shares. So that is the first exhibit. Now, using this exhibit 1, we have a first requirement is to discuss the accounting treatment of the acquisition of the subsidiary and the consideration. That was the first requirement. As you can see here, using exhibit 1, explain with calculation and in accordance with IFRS accounting standards how to correct the accounting treatment of the investment in a B company in a consolidated financial statement for the year ended 31st December 2007. Your answer should include the revised calculation of the goodwill arising on the acquisition of the B company. Total marks 10. So now I will debrief the answer of this requirement, and at the same time, I will be adjusting that information in the pre-populated spreadsheet as well to rectify the balance sheet. So coming back, to the question. This is the question. Now, I have already made some slides on the answer, so I will go to the slides. So as you know, EGAP company. So here, now we are the suggested answer of the question number 1. Now, first of all, as I told you earlier, that the acquisition of a B means you are having a significant influence because you have 25% shareholding. So first of all, it should be treated as an equity as an associate investment. not as a financial asset. That is the first issue which you need to identify here. It is our associate, not a financial asset. Not a financial asset. And the associate investments are accounted for using equity method in a consolidated financial statement. You can't treat them under IFRS 9 as a financial asset. They must be accounted for under the equity method, And how it will be done here? As you can see, we have a cost of investment, the amount at which we have done the investment, and then there is a mention that during the year from 1st January X7 to 31st December X7, there is a total 2 million profit is earned by a subsidiary company. So there is a post-acquisition profit of 2 million of the company. You will take the 25% share and record that share in the consolidated financial statement, and you will do it by debiting the investment in associate and crediting the group retained earning accounts or consolidated retained earning accounts. Okay. So, and further, they have acquired the subsidiary company, they have acquired the B company on 1st January, means 25% shareholding for 4.3 million. 0.5 million, they have a share of profit which they will record. So the carrying value of the associate company will be 4.3 plus 0.5 will be 4.8 million. So it will be accounted for using the equity method, and the investment in associate will be recorded in the financial statement. And let me show you again. You have invested the 4.3 million and you have 25% share, and your profit for the year was 2 million. So how I will adjust this information here? Look at here. Associate company. We have recorded it as a financial asset. So financial asset will be credited with 4.3 million. And investment in associate is debited with 4.3 million. And plus, you will add the 25% share of the profit, which is 2 million, and the 25% share of the 2 million will be 0.5. So you have 4.8 million. And that increase of 0.5 million will be added in the retained earning as well. So 2 into 25%. 2 into 25%. So that would be the accounting to treat it as an associate. Now, after treating it as an associate and removing it from financial asset, now at the year end, what happened at the year end? At the year end, they acquired further 45% shareholding. Acquiring further 45% shareholding in a company in which you already have 25% shareholding, that means you have a step acquisition, a piecemeal acquisition. You acquire a company in a piecemeal. So 25% on 1st January X7 and 45% you have at the year end it give you total 70% holding. So at the year end, you have a control. And when you have a control, that is your subsidiary. And that subsidiary must be consolidated. So it will be consolidated, and on the year end 31st December X7, which is also the date of acquisition, you have to calculate the goodwill. So you get the control, you have the majority rights now. This is a step acquisition. Control has been achieved in stages. IFRS 3 business combination requires that the previous investment, the investment which we already hold, should be measured at fair value at the date of acquisition. Now, what is the fair value? Number of shares of that subsidiary company were 5 million. Out of 5 million, 25% share we have acquired, 25% share. So 5 million into 25%. These were the number of shares. And at the year end, 31st December X7, it was mentioned in a question, in exhibit number 1, it is mentioned that the value of the subsidiary, value of the B company share at the year end, at the date of acquisition, was $5.7 per share. So 5.7 into 5 million into 25%, the fair value of the investment at the date of acquisition is 7.13 million. You can see 7.13 million. And the carrying value of the investment of the associate was 4.8 million. So we will take it at 7.13 at the date of acquisition. And any difference between the carrying value of the associate and the fair value of the investment at the date of acquisition will be recognized in a consolidated profit and loss account. In a consolidated profit and loss account. And in a profit and loss account, it will be recognized in an investment category. In the investment category. As you know, now after IFRS 18, we have operating activity category, investing category, financing category, taxation category, and discontinued operations. So it will be recognized as a gain 2.33 in an investing category of the profit and loss account. So, as you can see, we have already discussed the carrying value of the associate is 4.8. The fair value of the investment already held at the date of acquisition of the company is 7.13. So we have 2.33 million gain, which will be recognized in the consolidated profit loss account, and from profit loss account, it will be recognized in a group retained earning or consolidated retained earning. Now, they have also committed some mistake in the calculation of the goodwill that need to be rectified as well. The first mistake, they didn't consider the fair value of the previous investment. Second mistake, they didn't consider the consideration of the share, which should be considered. They only consider the cash consideration of the 15.1 million. And the other mistake they have done is they measure the NCI at proportionate basis rather than at fair value basis. So the share consideration should be recorded. Parent company is going to issue 1 million of their share, and the market value of the parent share at the date of acquisition was 3.2. So total 3.2 million shares will be recorded. Consideration will be recorded, and out of 3.2 million, 1 million will be recorded in a share capital and 2.2 million will be recorded in a share premium account. And then the second mistake they have done, they measure the NCI at proportionate rather than at fair value. So at the proportionate value they have calculated, they measure the 30% of 14 million and they recorded the value of the NCI. But it should be recorded at fair value. And the fair value was, they have the subsidiary company shares are 5 million. The market value per share is 5.7 and 30% is NCI share. So value of NCI at the date of acquisition should be 8.55 million. 8.55 million. But what they have recorded at the date of acquisition, they recorded the NCI at 4.2 million. 14 million fair value of the net asset into 30%. 4.2 million they have recorded. But the value of the NCI should be 8.55. So there will be increase in value of NCI at the date of acquisition, 4.35 million. And after doing all these things, obviously there will be a change in goodwill as well. Goodwill as well. So fair value of the previous investment 7.13, cash consideration, share consideration, fair value of the NCI, and fair value of the net asset. So the value of the goodwill is 19.98. 19.98 is the value of the goodwill. Is the value of the goodwill. Now we have to adjust these values in the consolidated financial statement. Now coming back here, acquisition of B, the name of the company. Now when I will acquire the Bryn company, obviously I will de-recognize the associate, and at fair value I will recognize while calculation of the goodwill, and as a result there will be a gain, and that gain will be recorded in a group retained earning, and that gain, if you remember, is 2.33 million. 2.33 million. So 2.33 million again will be recognized. So previous investment is taken at fair value. After that, they haven't recorded the purchase consideration in terms of share. That need to be recorded. So investment is debited by 3.2, but 1 million will be credited in share capital and 2.2 million will be credited in the share premium account. 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 Share premium account. So investment is debited with 3.2. Investment is debited with 3.2. Share capital credited 1 and share premium credited with 2.2 million. Cash consideration was duly recorded. Yes. NCI. The value of the NCI need to be increased by 4.35. So NCI value will be increased by 4.35. And the value of the goodwill, they have recorded the value of goodwill at 5.3. But the actual goodwill is 19.98. So there is an increase in goodwill as well. 19.98 minus 5.3. So the goodwill will be increased by 14.68. 14.68. So this will be the discussion and the adjustment in the consolidated financial position relating to Exhibit 1. So, in Exhibit 1, we have discussed the correct treatment of the B company and with the revised calculation of the goodwill, and at the same time, I have adjusted this information in the pre-populated financial position, Now, after this, now we will move towards the exhibit number 2. Exhibit number 2 is relating to post-employment benefit. For your reminder, just read it again. Using Exhibit 2, explain with calculation and in accordance with IS 19 employee benefit, how to account for the defined benefit plan in a consolidated financial statement for the year ended 31st December X7. 31st December X7. So how should we account for the defined benefit scheme? For that purpose, let's first of all read the Exhibit 2. And here we have the Exhibit 2. So EGAP has a defined benefit plan. You know, in defined benefit plan, employer record the net asset or a net liability because it is employer responsibility to fulfill the defined benefit pension. Employer responsibility is not just limited up to the contribution. He is responsible for the defined benefit. So they have a defined benefit, post-retirement benefit, IS 19. At 31st December X6, the benefit obligation value is 7 million. They have reported it as a non-current liability. Totally okay. Now, on 1st April X7, after 3 months, they have amended the plan with the additional benefit of on 1st April X7, 4.2 million. This is the past service cost. After the amendment, they have determined that the net obligation of 12.19 million because of the improvement in terms monthly service cost charge from 0.3 million before 1st April X7 to 3.5 million per month after 1st April X7. So this is current service cost. So after the improvement, current service cost, which was per month, is changed from April onward. Interest rate on a high quality bond at the start of the year on 1st January X7 was 5%, but after the amendment, it became 6%. Then the closing value of the obligation is 10 million. The only accounting entry which they have posted is to recognize the cash contribution of 4.1 million to the pension plan on December X7 in a consolidated profit and loss account. First of all, that is a mistake. That is the obvious mistake. The contribution which we made in a fund in a defined benefit scheme, we do not treat it as an expense. It is treated as an expense in a defined contribution plan, not in defined benefit plan. It is treated as an expense in a defined contribution, not in defined benefit plan. So in defined benefit plan, it should be treated as a reduction in liability, not as an expense. So you have to remove the expense. So here, defined benefit plan. So the contribution of 4.1. It will be added back in a group retained earning. Now, let's discuss the other issue of this plan. Now, this is a defined benefit plan, as we know, and there is an improvement in a plan, and that improvement in a plan is known as past service cost, and this past service cost is recognized fully in profit and loss account, in operating category of the profit and loss account. Okay, the past service cost. So whatever the past service cost, that should be recognized. So when a plan amendment or curtailment or settlement occur during the reporting period, interest for the remaining period calculated based on remeasured net obligation at the date of event using the discount rate which was applied to remeasure the net obligation. In this case, therefore, interest should be calculated for the first 3 months on an opening net asset, which is 5%, and opening net asset, which is a negative net asset, and obligation is 7 million. So 5% for 3 months, which is 0.09. And after the amendment of the plan, we will use for remaining 9 months, we will use the 6% rate to calculate the interest. And after the amendment, the value of the plan is 12.19 million. So 9 month interest will be 0.55 using the 6% interest rate. And causes a revision in a, and also there is a change in a monthly current service cost as well. Monthly current service cost as well there is. So for the first 3 months, you have 0.3 million per month. That is 3 into 300. That would be your first 3 months current service cost, and the remaining 9 months it becomes 0.35. So you have 4.05 current service cost. It is also recognized in the profit and loss account operating category. And the cash contribution, we have removed it from profit. We increase the retained earnings, and it should be treated as a reduction in liability because it is a contribution in a plan asset. And this is the revised calculation which need to be followed. As you can see, opening obligation was 7. First 3 months current service cost is 0.9. Past service cost is 4.2, and first 3 month interest calculated on 7 million is 0.09. So the obligation on the date of amendment is 12.19 million. 12.19 million. Then the next 3 month current service cost is 3.15 million, 0.35 into 9. Next 3 month interest will be calculated at the rate of 6% on 12.19 is 0.55. Contribution to a plan, which is treated as an expense, here treating as a reduction in a liability. And the closing value of the obligation is 10 million. And this 1.79 is the balancing figure, which is a remeasurement gain. And it is reported in other comprehensive income, and it is a loss. Now, if I report this information in the consolidated balance sheet, it will be as follows. First of all, the past service cost. The past service cost is 4.2, and with this 4.2, with this 4.2, your group retained earning will be decreased. Second thing is a current service cost in a first 3 months, which is 0.9. It will be recorded by debiting the group retained earning. Then interest for the first 3 months is 0.09, will be treated by debiting the group retained earning. Then the current service cost for the next 9 months after the amendment is 3.15 will be recorded by debiting the group retained earning. Then next 9 month interest 0.55 will be debited in a group retained earning, and the contribution is already adjusted by crediting the retained earning. As you can see here, it is already I have done at the start. And there is a remeasurement loss which need to be reported in other comprehensive income and in a balance sheet in a other reserve, which is 1.79. So other reserve, we will record a loss of 1.79. 1.79. 1.79. And the value of the closing liability. The value of the closing liability is 10 million. And at 31st December at 6, the value of the liability they have recorded is 7 million. So at the year end, it is 10 million. So there is increase of liability which is equals to 3 million, equals to 3 million, equals to 3 million. So you can simply take 3 million here as well directly. Otherwise, if you net the all current service cost, contributions, remeasurement gain loss, net effect will be the 3 million. Net effect will be the 3 million. Now, after doing this, if you calculate the adjusted statement of financial position, value of the property, plant and equipment will remain the same. Value of financial asset will be changed. Value of investment in associate, value of goodwill, and the total value of non-current asset will be 175.68. There is no change in a current assets. So the total assets will be 221.9. Share capital will be 81. Share premium 2.2. Other reserve, group retained earning, this is NCI, and total value of the equity will be 164. 33 and current liability will be 21. So now the total okay to 18.4. Just a minute. Okay, yes, just a minute, just a minute. Look at here. This is 1.7, 1.79. I treated this as a loss, but it is a gain. It is a reduction in liability. It's a reduction in liability. So just a minute. Yes, now you can see here the equal. So that was basically the gain that will need to be credited in other reserve. So here you can see the balance sheet is equal. So here we have discussed the question, and the question is EGAP from March June 25. Hopefully you people will understand that how to attempt the consolidated question. You are explaining and answering the exhibit 1, exhibit 2, and at the same time you are adjusting that information in the pre-populated given balance sheet in a financial position or in a given pre-populated profit and loss account and other comprehensive income, and eventually your total question will be solved simultaneously, and it will help you to solve the question in a more better way. Hopefully you have enjoyed the video, and I will keep you update in future with my coming video. So thank you very much, and see you in a next video very soon.